Welcome to the Deep Dive. We dig through stacks of research and notes to pull out the key insights for you. Today, we're jumping into something that might seem a bit dry, maybe, but it's absolutely vital if you're dealing with the financial world. We're talking about how financial institutions, or broker dealers, the places that handle your investments really work behind the scenes. The big question for today is, how do they make sure they actually know you and that the advice they give is, well, right for you specifically? And how do they do all that while also guarding against things like money laundering?
Exactly. And this deep dive, it's really about pulling back the curtain on those processes that can seem pretty complex. We want to show the layers of protection that are built into the system. Think of it as a shortcut to understanding, the foundation of financial security and trust. We'll look at the rules for opening accounts, what suitability really means for investments, and, the crucial steps against money laundering, AML.
Okay, let's dive in then, starting with what feels like the simplest thing, opening a new account. But for broker-dealers, it's not just filling out a form, is it? It's like the starting point for this huge web of requirements. And it's not just red tape either. Good record keeping is absolutely essential. It protects customers, the firms, even the reps handling the accounts.
Precisely. And that's where Know Your Customer KYC comes in. It's a FINRA mandate. Firms have to use reasonable diligence to know the essential facts about every customer and anyone acting for them, too. Plus, you layer on top of that the USA Patriot Act. That adds more requirements for verifying identity and keeping an eye on things, specifically to fight money laundering. It's pretty thorough right from the start.
Right, and when you say minimum information, what exactly does that cover? They need this before the first trade, you said.
Yes, before the initial order. So basics like your name and your actual residence. A P.O. box won't work for opening the account itself, though you can get mail there later. They also need to confirm you're of legal age, know which registered rep is handling the account. And crucially, a principal with the firm think a manager or supervisor has to sign off, approve the account opening.
Okay, but does this apply to absolutely everyone? What about big players?
Good point. There's a distinction for what's called an institutional account. So think banks, insurance companies, maybe an entity with assets of, say, $50 million or more. For those, some of these specific rules might not apply in the same way. The system recognizes they're, more sophisticated.
Gotcha. So that's the starting point, but just name and address. That doesn't tell them much about what investments fit, right?
Exactly. So the rep needs to make a reasonable effort to get more info. This usually happens before the settlement date of that first transaction. We're talking about your taxpayer ID number, Social Security number for most individuals, also your occupation, who you work for, and, interestingly, whether you're associated with another member firm. It builds a clearer picture.
And I always have to sign the form. I feel like I always sign something.
Well, it's common practice, and firms often require it. But technically, the industry rules don't mandate a customer's signature for a simple cash account. Now, if you want margin or options trading, then yes, a signature is absolutely required, right? Because there's more risk involved there.
Wow. Okay, and it goes even deeper. SEC rules.
Oh, yeah. SEC Rule 17A3 lays out extensive records broker-dealers have to keep for every customer. It's like building a detailed financial profile.
Yeah.
Name, tax ID, address, phone, birth date, job status. And financials like annual income, net worth. And here's a key point. Net worth excluding your primary home. Plus, crucially, your investment objectives. It's a full snapshot.
But what if someone's, hesitant? Maybe they don't want to share their income or net worth.
That happens. The firm should document that refusal. Just note it down, basically. And a principal can actually refuse to approve the account if they feel they don't have enough info to judge suitability or understand the client's goals.
So there's a balance there. Necessary info versus privacy.
It's a delicate balance, absolutely. The firm needs enough to meet its obligations, but also respect privacy. It's about protecting the customer, ultimately.
Okay, here's something interesting you mentioned earlier, the trusted contact person. What's that about?
Right. This is a newer requirement. Firms have to make a reasonable effort to get the name and contact info for a trusted person when you open an account. And if you provide one, they have to tell you in writing that they might contact this person under specific circumstances.
And what are those circumstances? They can't just call them for anything, right?
No, definitely not. It's very specific. Primarily, it's to address concerns about possible financial exploitation, like if they suspect fraud or something. Or maybe to confirm your contact details if they can't reach you, check on your health status in certain situations, or identify a legal guardian or executor if needed. It's really an extra safety net, especially for potentially vulnerable clients.
And keeping this info up to date, that's ongoing.
Yes. Firms need to send you a copy of your account record within 30 days of opening, or maybe with your next statement. Then they have to periodically send it out for verification at least once every 36 months.
So that's why we sometimes get those update your info requests.
Exactly. It's not just busy work. It's part of ensuring they have accurate information continuously. And if you do update something, change your address, your job, maybe your investment goals change, the broker-dealer has to send you a copy of the revised record. And for an address change, specifically, they have to notify both your old address and the rep handling your account within 30 days. It's about diligence.
Okay, so we've got this detailed picture of the customer. They know who you are. But knowing someone isn't the same as giving them the right advice, is it? Which brings us to suitability.
Right. This is really the core of trust in the relationship. Suitability. The idea is simple. Only after understanding your financial situation and needs can a rep make appropriate recommendations.
Makes sense. So how is this suitability obligation defined, especially for regular folks, retail customers?
Well, any recommendation for a specific investment or even an investment strategy like suggesting day trading has to be based on the customer's investment profile.
Ah, the profile again. Remind us what goes into that.
It's pretty comprehensive. Your age, other investments you might have, your overall financial situation and needs, tax status,
Oh,
also your investment objectives, what you're trying to achieve, and your experience level with investing. Plus, your time horizon, how soon you might need the money back, so liquidity needs, your tolerance for risk, and really any other relevant info they gather.
that's a lot. Do people have to provide every single piece?
Not necessarily obligated to provide everything, but the registered rep, the RR, should try to gather as much as possible. Why? To make the best recommendations. And here's the absolute key. The recommendation must be in the customer's best interest, not driven by what makes the RR the most money.
Right. Avoiding conflicts of interest. And you mentioned some clear examples of violations earlier.
Yeah, the source material points out things like recommending something just because it has a huge commission, or pushing a certain mutual fund class to maximize the RR's payout, suggesting using margin mainly to generate more trades and commissions, even pushing a firm's own new stock offering really hard just because management wants them to. These are all potential suitability violations.
Okay. And Fine Art breaks this down further, right, into 3 specific obligations.
That's right, 3 main parts to suitability. First, the reasonable basis obligation. The firm and the RR need a reasonable basis to believe the recommendation is suitable for at least some investors. Basically, understand the product before you recommend it.
Okay. Basic due diligence.
Exactly. Second, the customer-specific obligation. This is crucial. They need a reasonable basis to believe the recommendation is suitable for this particular customer based on their specific profile.
Tailored advice.
Precisely. And third, quantitative obligation. This one's about frequency. Even if each individual trade seems suitable, a series of trades shouldn't be excessive or churn the account, considering the customer's profile.
Right. No excessive trading just to generate commissions.
Exactly. It's about the overall pattern of activity.
You know, what's interesting is how age fits into this. It seems like a big factor, but maybe not always.
It often is, but yeah, it's nuanced. Age isn't always the deciding factor. Like, if someone, regardless of age, says, I need this money liquid in 6 months for a down payment, then liquidity need trumps age and suitability. Or if someone's primary goal is just preserving capital, keeping it safe, their age might be less relevant than that objective. It really depends on the specific circumstances.
And what about those big institutional clients? Is suitability different for them?
It is, yes. The obligations adapt based on the institution's sophistication. There are 2 main guidelines here. 1, the firm and RR must have a reasonable basis to believe the institution can evaluate the risks themselves, independently. And 2, the institution have to affirmatively state, yes, we're using our own judgment here.
Yeah.
If those conditions are met, the firm is actually exempt from that customer-specific suitability piece for that institution.
Oh, okay.
But they still have the reasonable basis and the quantitative obligations. Those always apply.
Right. Okay, so we've seen how they get to know you, how they ensure advice fits, but there's this whole other massive area, protecting the entire system from crime. Let's talk anti-money laundering.
AML.
Yeah, this is huge. AML efforts are critical for the integrity of the whole financial system. The main law here in the U.S. is the Bank Secrecy Act, the BSA.
Yeah.
And it was significantly updated and strengthened by the USA Patriot Act.
The Patriot Act. That came after 9/11, right? Yeah. Exactly. Signed into law by President Bush following the attacks. It placed significant new obligations on financial institutions, including broker-dealers, specifically aimed at detecting, deterring, and disrupting terrorist financing and other illicit money flows. It really ramped up the focus.
And money laundering itself.
Eh.
It happens in stages, doesn't it?
Yes, typically described in 3 stages.
Yeah.
First is placement. This is getting the dirty money into the financial system somehow. For a broker-dealer, that might mean buying securities with illicit cash.
Okay, getting it in the door.
Right. Then comes layering. This involves conducting multiple, often complex transactions to obscure the source of the funds and confuse the trail. Like that structuring example you mentioned, breaking large amounts into smaller chunks under reporting thresholds.
Trying to fly under the radar.
Exactly. Buying multiple blocks of stock with cashier's checks under $10K from different banks, maybe. Or using different accounts, taking opposing positions. Lots of ways to try and muddy the waters.
Okay, placement, layering, then what?
Integration. This is where the money, now clean through all those layers, is reintroduced into the legitimate economy. Like selling those securities bought during layering and depositing the clean-looking proceeds into a bank account, maybe using it to buy assets. The money now appears legitimate.
Wow. And who polices all this?
A key agency is FinCEN, the Financial Crimes Enforcement Network. They're part of the Treasury Department. Their job is to develop and enforce AML policies. They do this mainly through 2 things. 1, requiring financial institutions to file specific reports on transactions. 2, analyzing that data and providing intelligence to law enforcement.
Okay, so what reports are broker-dealers filing?
2 main ones to know. First, Bank Secrecy Act Currency Transaction Reports, or BCTRs. These are required for any cash transaction or series of cash transactions by one customer in one day that exceeds $10,000.
Cash specifically.
Yes, currency and currency equivalents. So your example was great. Depositing $6,000 cash, then $7,000 in traveler's checks later the same day, that totals $13,000. Boom, BCTR required. And reps really need to watch out for that, structuring someone deliberately making multiple deposits just under $10 to avoid the BCTR.
Right. Okay, that's for large cash deals. What's the other report?
Suspicious Activity Reports, or SARS. Interestingly, before the Patriot Act, it was mainly just banks or bank-affiliated broker-dealers filing these. Now all broker-dealers have to.
Okay, and what triggers in SAR?
A firm files in SAR if a transaction, or a group of them, involves $5,000 or more, and the firm suspects something fishy, like potential violation of federal criminal laws, funds possibly linked to illegal activity, transactions that look structured to evade reporting, or just transactions that seem to have no logical business purpose or aren't typical for that customer.
And these SARs, they're kept quiet, right?
Absolutely crucial. Confidentiality is paramount. Think about it.
Well, yeah, if the person knew, they'd just stop or disappear.
Precisely. The secrecy allows investigations to proceed without tipping off the potential bad actors. So under no circumstances can a registered rep or anyone at the firm tell the person involved that a SAR has been filed about them. The only people they can tell are federal law enforcement or securities regulators. It's incredibly strict.
Wow. Okay, that really covers a lot of ground. It brings us full circle, doesn't it? From just opening an account to getting the right advice to these huge systemic protections. It's an incredible amount of detail and constant vigilance. It really is a complex system, all designed ultimately to protect individual investors and the integrity of the whole economy.
That's right. And understanding these rules, it's not just about compliance checklists. It's about building and maintaining trust. That's what makes the financial system work. Knowledge here is really about understanding that foundation of trust.
So for everyone listening, what stands out to YU? Does knowing about these rigorous KYC rules, the suitability checks, the AML efforts, does it change how you view financial institutions? Maybe something to think about. How these often unseen layers of compliance, which can feel bureaucratic sometimes, are actually the quiet framework supporting the security and reliability of nearly every financial step you take. They help create a safer, more transparent global economy for all of us.